Hello and welcome everybody. I see it's just gone 12 p.m. here in South Africa, so good afternoon to everyone joining us in SA. I see we've got about 640 people joining us and counting, so we'll give some participants a bit of time to join us. And of course, it's a little earlier in London where some of my colleagues are joining us from, so good morning to you all. Welcome as well to our update on our global portfolios. So this is for the STANLIB Global Equity Fund and the STANLIB Global Balanced Fund. So today we've got portfolio managers and client portfolio managers on the line, and we're going to go through about an hour session with each of the teams, and then leave some time for questions at the end. Thankfully, this time it's not going to be a death by PowerPoint session, which I always enjoy, which means we can hopefully get into lots of nice, interesting chats about what's been happening in the markets abroad. On the line, I've got Alex Lyle, who is our portfolio manager for STANLIB Global Balanced, as well as our Global Balanced Cautious Fund. And he's joined by Craig Norrie, who is the client portfolio manager, and they'll kick us off with around about a 20-minute session, sort of chat and Q&A around what's been happening in global multi-asset. And then it'll be followed by Neil Robson, who's our portfolio manager for STANLIB Global Equity. And he's joined by Andrew Harvey, which some of you may have met subsequently when we were still traveling around the globe. Andrew's joined us a few times in South Africa. And he'll be running the session as well with Neil. So lots to chat about. I think we're all sort of waiting with bated breath on some of the big decisions that we have to make in portfolios in a year like this, where we're all sort of questioning the end of COVID and what post-COVID portfolios are going to look like. And I suppose it continues the ongoing discussions around the growth in technology. Of course, we're always a business to chat more around not just big tech, but technology and how that affects every business across the market. And of course, wanting to understand what the inflation reviews are, because I certainly think that's one of the biggest questions going into 2021. So lots to chat about. Just on the house front, I'll be managing the Q&A box, so please do feel free to pose questions. We'll try and manage some of those questions in each of the 20-minute sessions, but if I don't get to them in the session, then we'll certainly try and get to them at the end during the Q&A. Great, I think we're at about 800, and I think we've probably got well over 1,000 people registered for this event, but time is of the essence, so I'm going to kick off with Alex and Craig.
Thanks, Sarah.
So
Sarah's really touched on some of the points that my first question is going to be towards Alex in terms of, look, we are seeing some flare-ups in terms of COVID, and we're seeing some of the economic indicators starting to come off the top. So I'm really interested for the wider participants and what your view of the global economy is.
Sure, and good morning or afternoon to all of you listening. Certainly, I mean, I'm still optimistic about the outlook for global growth. I mean, as you say, there certainly are some nasty escalations of COVID around the globe, but these tend to be fairly localized. And generally, I'm very encouraged by the number of vaccines that have been approved and the rollout programs for those, which should allow fairly rapid reopening again, where there have been escalations. So overall, I think we're seeing some very encouraging economic indicators, both in relation to business confidence and in relation to consumer confidence. I think there's huge pent-up demand post-COVID, and savings levels for individuals are high. There was a lot of forced savings. People couldn't spend during lockdown, and now they've got the opportunity to do it. And they want to go out and enjoy themselves again to some extent, having had a very harsh 18 months. If we look at construction, employment, consumption, they're all showing very good growth rates. We see a clear V-shaped recovery coming out of COVID. In fact, in the US now, real GDP is running back at pre-pandemic levels. That's quite an achievement, quite a recovery.
And you mentioned this pent-up demand. This pent-up demand seems to be creating a bit of inflation. And that's one of the things that Sarah mentioned, is that people are concerned about the rising inflation. What's your view, or what's your take on inflation?
Well, certainly, as you and Sarah have both said, there are concerns about inflation, and we have seen some material rises recently. Because in some areas we've seen big increases in demand post-COVID, and at the same time supply issues. But we see this as a short-term spike caused by these bottlenecks and dislocations because of COVID, not a medium-term issue. And if we look at the sorts of areas where we're seeing inflation, I mean, for example, second-hand car prices in both the UK and the US are running at 10% price increases year on year. So huge increases. But that's because demand has gone up a lot due to COVID. People don't want to travel on crowded public transport at the moment. They feel safer in their own cars. And at the same time, supply has been limited because of the chip shortages we've heard about. So there aren't the same number of new cars coming onto the market, and therefore we're not getting the second-hand cars coming on either. So very specific there. If we look at building materials, that's another place we've seen a lot of inflation recently. And that, again, is because during lockdown, there was very little construction activity. And now there's a need to build up housing again. And at the same time, government fiscal packages are including infrastructure spending, which requires building materials. So we've seen inflation there. Another area we've seen it actually is in some food prices, because there's delivery problems, because there's a shortage of truck drivers. And in that instance, there were very few truck drivers being up during lockdowns. So I do think they're all quite specific and quite immediate post-COVID problems. In the medium term, I think all these problems can be sorted out, capacity can be increased again, and we would expect inflation to drop back down to the sorts of levels we've had over the last 20 years in the major economies, which is sort of 1% to 2.5%, a very reasonable and acceptable level.
Okay, so with the general background of being optimistic on global growth and inflation being transitory, so these short-term spikes, how do you believe that central banks will react to this type of environment?
Well, I think our views and the central bank's views are pretty aligned on this one. They likewise see it as a short-term spike, not a longer-term problem. And they have stressed that they will keep monetary policy fairly loose, given that situation. They really don't want to snuff out the strong recovery that's taking place. And as a result, we expect central banks to remain pretty dovish, keep interest rates low, and only taper quantitative easing very slowly and gradually. So we would expect monetary policy to remain very supportive for all types of market.
Okay, and so what's your view in terms of equity markets? How are you feeling about equities at the moment?
Well, certainly we remain optimistic on equities and see equities as the most attractive asset class at the moment. If we look at the background, as we've discussed, the global growth outlook is encouraging, which is obviously very helpful for corporate earnings. And absolutely crucially, at the moment, companies are reporting good figures, good profits growth. And that's in all regions. I mean, at the moment, we have just about finished the second quarter US reporting season. And the figure is 87% of companies have come in with profits ahead of market expectations. That's a very high percentage of companies. And they're not just beating by a small amount. The average beat is 17%. So as a result, companies are reporting good profits. We're seeing upgrades to forecast, which is always helpful for equities, and we're seeing good dividend increases. And that's what so many investors invest for, that supply of income. And we're also seeing a lot of bid activity. Partly companies are bidding for other companies because of the good profit outlook. They've got the cash and their confidence is good. And at the same time, private equity and private equity funds have raised huge amounts, and they are in the market making acquisitions. And obviously bids helps the supply and demand situation for equities. So in summary on equities, they're not cheap. They have had a very good bull market, but we think they've got further to go.
Okay, thank you. And so you talked about the US companies and how well the US companies are doing, but if we see the last few weeks, we've seen quite a bit of volatility in Asia in terms of increased intervention, regulatory intervention from the Chinese authority. What's your take on this, and how do you see this developing?
Yes, well, that has been disappointing recently. Asian markets have been weak, especially Chinese stocks. And this has been, as you say, in response to increased intervention by the Chinese authorities. First, it was the internet companies, then it was education companies, and now people are worried it might spread to property companies, it might spread to healthcare companies. What it seems to be is a policy that they've mentioned a few times recently, referred to as common prosperity. And what it seems this involves is limiting sort of non-essential expenditure, the more upmarket expenditure, and encouraging more mass market expenditure. So creating a more level playing field where the rich aren't getting quite so rich and the poor are being helped. How far this policy might go and what it might mean for other areas of quoted equities is unclear at the moment. But there's no doubt that the risks in the area have risen. But on the positive side, the Chinese economy remains very robust, and news from other areas in Asia is encouraging. Areas like Taiwan, Korea are reporting very good economic numbers and profits numbers. And the Chinese authorities do realize how important the private sector is to generate wealth and encourage consumption. So I don't think they'll want to do too much damage there. And also encouraging mass market areas will throw up some good opportunities in that part of the market. Things like food companies, essential technology, and so on. So I do think that Asia remains attractive, but one has to say less so than it was.
Okay, well, thank you. And I don't really want to steal too much of Neil and Andrew's thunder, so why don't we try and navigate our way towards fixed income? And how are you viewing fixed income at the moment? And is there any opportunities within fixed income?
I mean, fixed income, the background is very encouraging, really. As we've said, we expect central banks to remain dovish for some time, which means low interest rates. It means ongoing quantitative easing, buying up bonds, which keeps the yields down. And as I've said, we don't anticipate medium-term inflation. So expecting it to drop back down to very manageable levels, that is encouraging for bonds. But the issue with bonds is, to us, current yields just aren't offering much in the way of value. We don't expect yields to shoot up. We don't expect a lot of weakness in bonds by any means. But just for a medium-term investor, there is very limited value in an awful lot of government bond markets. And so we see better returns from other asset classes. Within bonds, there are areas clearly more attractive than others. And when we look at government bond markets, treasuries in the US to us are one of the more attractive. a yield of sort of 1.3% at the 10-year level, compared to elsewhere, is a reasonably healthy yield. And our expectation for interest rate rises in the US would be for them to be slower than market consensus at the moment. Another area in government bonds we think is fairly attractive is peripheral Europe, where that incremental spread you get in yield above a German Bund has come in quite a long way, but we still think that the spread left offers a bit of extra value. Corporate credit, again, is an area that looks quite attractive. Again, that incremental yield or spread you get over a government bond is still reasonable. It's coming a long way. But given the fact that we're optimistic on growth, we think that the risks in this area are fairly limited. And therefore, we think that that is an attractive area within bonds.
Okay. So far, we're positive on equities, more cautious on fixed income, looking to take advantage of higher spread. The final part of the STANLIB balance fund is the property element. So can you give us your view on property?
Sure. As you say, we're optimistic on equities, less so on bonds, and property comes smack in the middle. We have a neutral position on bonds, on property. I mean, there clearly are some negatives out there. And the one that most people talk about is the bricks and mortar, retail, high street shopping areas where trends have moved against them. Everyone's moving onto the internet or big out of town shopping centres. So high street shopping is very difficult. The other area that's become much more questionable recently is offices, where in the post-COVID world, people working from home more, how much office space will be required. And the jury's out on that. I mean, initial figures and indicators are that things probably won't be too bad. But still, there's definitely a question mark there. So those are a couple of negatives, but at the same time, there are positives in property. Loose monetary policy that we've talked about by central banks is very supportive. It provides cheap finance for the property sector. The yield on the asset class is good, and a lot of investors are looking for income, and property stacks up in that respect. But I think very importantly, in addition, our team have identified a number of very attractive growth niches within property, and those are the areas they're focused on, which should give attractive potential. Areas like logistics for distributing all that stuff we're buying over the internet, residential property in a number of areas. Germany, for example, where they've seen a lot of immigration over the years and therefore a housing shortage. Residential in the US, catering for the retirement market, the aging population, demographic change, and so on. Self-storage is an area they like because people are trading down to smaller units, and therefore, rather than biting the bullet and selling their furniture, they put it into storage for a bit and then tend to leave it there for the long term. So that's attractive. Data centers for the cloud. Cloud computing is growing at a phenomenal pace, and it does require an awful lot of computers. That's an attractive area. Towers for Wi-Fi and mobile masts and other areas. So those are some examples of really interesting niches within property that the team like. So as I said, it's a bit 50-50 property. There are those negatives I mentioned at the front, but there's some positives as well. So net, we take a neutral position on property.
Okay. Thank you, Alex. That's been very insightful and very informative in terms of we're looking for good continuing economic growth. I'm still optimistic. We think the inflation is going to be very transitory with short-term spikes. A loose central banks, equity market still doing well. You've seen strong earnings coming through, negative on bonds and neutral on property. I don't think, I think at this point, I just thank you, and I'll pass over to Andrew and Neil to speak more about the global equity holdings.
Brilliant. Thank you, Craig and Alex there. And really reassuring from our side to hear that your kind of preferred asset class is equities. Obviously to equity, that's music to our ears. But Neil, perhaps I thought we could start kind of our little session by having a look at what's worked in equity markets over the past 18 months or so. It's clearly been somewhat of a roller coaster. We've seen kind of one of the largest drawdowns in March last year, followed by a very kind of sharp and rapid recovery. So maybe kind of just a bit of insight from your side on what's worked and kind of what's not over this past 18 months, please.
Yeah, thanks, Andrew. As you say, it's certainly been interesting. I think, if you think about it over the last year, as you said, volatility has been incredible. We've gone through different style rotations within marketplaces. I think there isn't a single investment process that wouldn't have been challenged over the last 18 months. So the way I'm thinking about it is very much actually over the course of the pandemic, did the process add value or not? So if you think about it, we had started off the pandemic, we were literally switching off the economy as everyone used their front door as the best method of protecting their health. That caused a deep recession to start. Our portfolio did exceptionally well during that phase. Many of the long-term trends that we've been investing in for the last decade or more did exceptionally well in portfolios. We then got the central banks rode to the rescue in March, and as that happened, markets bottomed. We got the 50% or so rally by kind of midsummer, and it was a matter of just trying to hold on to markets. Can we stay level? And we did pretty much that over the summertime. And then really what switched was November the 9th, when we got the first evidence that vaccines worked. And with that, the whole reopening trade with that start to take off. And that was very much a value reopening type trade, the things that were more distressed doing better. And that really went through till early mid-April this year. And during that phase, our portfolio, which is, we are quality growth managers, so our portfolio tended to lag over that phase. And then just when we were seeing lots of clients shift across to value, we then saw growth come back with a vengeance because bond yields weren't going north of 2%. They were suddenly going in the opposite direction, as I guess we were sensing that, reopening is not a straight line. We can point to, I think Austin, Texas was in the news the other day because, they're running out of hospital capacity in Austin, Texas, despite being, high levels of vaccination. I think every province in China has cases of COVID right now. It's not a straight line, reopening. And I guess also, we're just starting to hit some year-on-year peak rates of growth. If you were running a restaurant last year, you were closed, you're open this year, that's one hell of a growth rate. It's not going to happen again over the next 12 months. So I think there's some sort of sense of that as well. What I would say is that our quality growth businesses have tended to gain market share over this time period. They've tended to see innovation and the adoption of that innovation actually accelerate, whether that be everyone suddenly using PayPal to transfer money around, whether that be people suddenly accelerating their cloud adoption. I think in our office, one of the few people who were actually in the office during the pandemic lockdown were our IT staff, maintaining the servers, etc., in the basement. Wouldn't have to do that if we were, on the cloud with Amazon or Google or Microsoft Azure. So I think it's been an interesting environment. I'm glad to hear that Alex is positive on equities. Of course, that's the way to be. But I think, we're looking back over the volatile period thinking, we've added quite a lot of money for clients over that time period.
It's certainly been, as you say, an interesting time. But I guess what I'd quite like to pick up on is you mentioned kind of value coming back this year. And I guess certainly if I think back at kind of conversations I've had with clients towards the end of every year, kind of over the past 5 years or so, it's always about the discussion of, is next year going to be values year? And I guess kind of value is all about averages, kind of, mean reversion, returning to averages. What's your take on the kind of, I guess, the sustainability of this value rotation and whether this kind of post-COVID environment really will be good for the average company out there?
Yeah. So I think, take it as one thing. We switched off the economy. We're switching it back on. As Alex has already said, none of us is missing the wherewithal in order to go back to consuming what we were before. So therefore, the first stop is kind of, does it rebound to where it was pre-pandemic? And we've already heard US GDP is already at levels despite employing 6 million people less in the workforce. I think we've got services still to come back. Stock markets, I think it's largely been discounted. I was looking at EasyJet, the European airline, the other day. If you look at the enterprise value, the market cap plus net debt of that business, it's now 25% above where it was pre-pandemic. Now the share price isn't, so if you go and look at the share price chart, you're going to tell me I'm wrong, but actually they've actually taken on 2 billion sterling's worth of incremental debt because they had an awful lot of costs during the pandemic and no revenues. And they've also issued 15% more shares outstanding because, again, they were trying to finance themselves during the pandemic. But if you look at that, paying 25% more for that airline now than we were pre-pandemic, I think the reopening is pretty much being discounted. I mean, Andrew, I know you loved flying everywhere, but I'm not doing much of it yet. And I think we're creeping. I think this creeping reopening has actually been largely priced. Is it sustainable beyond that? Are we going to see a different level of economic activity or economic growth compared to what we saw post GFC? Personally, I'm not seeing it. I think the debt overhangs are too big, particularly with governments. But time will tell. But I think we still, it's a reasonable level of economic growth, but it's not gangbusters. And I think gangbusters economic growth is what's required to make value typically work. And I'm sure we're going to get onto it, but there are also some trends in the economy that might make you think that the disparity between those businesses that can grow and those that can't should be perhaps be wider now than it has been historically.
Okay, great. So before we talk about those trends, I'm very kind of happy to do my EasyJet share price kind of when some normality kind of returns, and looking forward to that. But one of the buzzwords, I guess, kind of value has been a buzzword this year. Inflation has been a buzzword. Kind of Sarah mentioned it in her opening. We've heard Craig and Alex kind of talk about it. I mean, I guess any additional comments from your side, particularly as it pertains to kind of equity markets?
Yeah, I mean, Alex covered a lot of it. I would say, think of it as the economy was switched off and we're switching it back on again. So we're switching it back on to full levels of demand, and it's meeting constrained supply. If you were a business during that, during the pandemic, you probably took down your inventory levels. So you need to demand that, you need to boost your inventory levels. And that was true of your suppliers. They probably need to, increase their levels of component stocking and all that sort of stuff. And that restocking in the economy is trying to happen in a much faster way than in a typical economic cycle, because it is literally the light switch. And that's causing lots of problems. And Alex highlighted, I think he highlighted shipping costs, that clearly you can look at shipping costs. Steel prices have spiked to levels where you're seeing, you haven't seen them for a long time. He mentioned secondhand car prices. My daughter went to buy a secondhand car and then dragged me along a week later, it had gone up £500. We have a situation in the US now where I think 80 models in the US are actually pricing the 1-year-old vehicle, maybe with 10, 15,000 miles on the clock, pricing a 1-year-old vehicle at a premium to the new vehicle. Why? Because there's just a lack of availability. Is that normal? Will that be there this time next year? I'm pretty sure it won't. It'll go back to being, discounts on new vehicles and, probably a £3,000–4,000 discount compared to the on the old second-hand vehicle. We're beginning to see in some instances that tightness on certain material costs beginning to fade. The most dramatic example is lumber. So in America, it's a timber framed house, so timber prices are very important. If you look at lumber price, it spiked dramatically tail end of last year, beginning of this year, as they went back to trying to restart lumber or restart the housing building, and there was just a problem, the supply chain adapting to that level of activity again. There's no shortage of trees, but there is a shortage in terms of lumber mill capacity and actually transporting and logistics to get it to building sites. The spike took the price per 1,000 board foot to over $1,600. As we speak today, it's $530. So we're clearly well past that inflation spike. And I think we're going to go through similar types of things as we go forward. Not totally dismissive of inflation. There are some areas where you're going to see a little bit of labor cost. If you worked in hospitality last year, you were put on furlough, then you were probably made redundant. You went off and found something else to do. Will minimum wage and the fact that you have to wear a mask for 8 hours a day attract you back into your prior job? I kind of suspect not. So there's a little bit of pricing that has to occur to get resources to move back around the economy. I still believe it's transitory. There are lots of deflationary forces still in the economy.
Okay, interesting. So maybe kind of you touched on cars, and maybe taking a kind of a tangent here and kind of the auto industry. I guess one of the things that I personally noticed over the past, over lockdown and kind of last year was, with the lack of kind of cars on the road, the lack of planes in the skies, you could hear the birds tweet a bit more. Kind of the air seemed fresher. I think we all became ever more aware of our impact on the environment. We've got COP26 taking place this year. We've got wildfires currently raging in Greece and parts of Europe. South Africa continues to have a kind of an issue with water scarcity. I guess the environment is a really big concern for everybody across the globe. How do you think about this in kind of portfolios, and how do you think about it when you look at the equity markets? Because I know that there's no exposure to traditional energy companies in the global equity portfolio.
Yeah, I mean, I don't think anyone can be in existence these days and deny what's happening out there. And I think the other thing that really strikes me is that it's now. It's not kind of at some hypothetical point in the future. It is really now. And I think that's exactly the same when we're looking to invest in businesses. The change is occurring now, and at a faster rate than I would have guessed, even going back 2 or 3 years ago. So when you're looking at it, I mean, we're a member of UNPRI, we wear lots of badges and all that sort of thing, but think about it as an investor. What do you want to achieve? Well, the first thing you want to think about is risk. This business that's in front of me that I'm considering making an investment in, is it still useful to the world going forward? Is it going to still exist? Will its profit metrics and margins and so on structures, will they change over time? Will there be new regulations that are going to face it? There are lots of challenges to business. You mentioned energy. Energy is probably the most preeminent one. You mentioned autos. So let's think about it. Let's suppose, Andrew, you go off and you buy yourself a new diesel vehicle now, today. The average lifespan of a car is what, 10, 12 years, something of that sort of order. Well, let's assume you're one of those good people who actually keeps a car rather than replacing it every 2-3 years. That's the last car you'll have ever bought, the last diesel vehicle. Because from 2030, it will become illegal to sell you an ICE, an internal combustion vehicle car. That's quite dramatic. That's now. That's happening reality today. You think about the auto. If you're an auto company, you've got a model cycle which is probably 7 or 8 years for every you renew your models. So you've got effectively one model cycle left before all of your vehicles need to have a different propulsion mechanism. That is dramatic. So first thing is, does the business exist? Does it fulfill that? So we have made investments in tangentially around electric vehicles, whether it be T connectivity, who benefits by having more components within an electric vehicle than an internal combustion engine, whether that be Samsung SDI on batteries, whether it be a business like General Motors. General Motors no longer employs any engineers at all who focus on the internal combustion engine. That's a dramatic statement. They are all in on this change. So risk is the first thing we need to consider. But think about it. What we've just described is massive opportunity for those that adapt. And entrepreneurs are looking out there, business leaders are looking out there, trying to adapt, make sure that their businesses are put in the right way. Energy we are clearly suspect on, but if you look at someone like BP, their transition that they announced last summer, you've got one of the world's major oil companies saying in 10 years' time we will produce 30 to 40% less oil than we do today. That you can derive that exactly from their capital allocation. So things are changing dramatically. So risk on one hand, opportunity on the other. We have an investment in a business called Schneider. They do low voltage electrical equipment, building controls, things like that. We'll mention digitization at some point, but the whole digital economy. But more importantly, as we electrify the economy, then there's going to have to be massive investment in the grid. I think overnight we finally got the infrastructure bill in the US approved for $1 trillion. I think by the time you actually net off what was already committed, I think it's 600 billion rather. So it's important, but it's a drop in the ocean compared to what's going to have to be invested in, say, our grid systems in order to shift us towards electrification. I think the IEA report recently talked about 10% per annum and above grid investment growth. And Schneider's linked into that, but more importantly, because there is a very important software control layer, we're all sat in big buildings. You've got to first of all measure and then manage the amount of CO2 emissions coming out of those buildings. You need a business like a Schneider or a Honeywell to actually, first of all, collect all that data and then help you manage it. The number of companies who can actually fulfill that now is a handful. And as a result, Schneider end up with a faster tailwind of growth because of these trends, and also a better competitive environment because of the software control layer that very few companies have. So there's a business that historically we would have perhaps, we might have owned, but it was a bit marginal, is now looking much more like a core holding over the next 10 years.
Okay, so kind of, I guess, this theme of focus on the environment and decarbonisation is both a kind of an awareness of risk and can also huge amounts of opportunity. And I guess, as we look ahead, probably one of the enduring, I guess, multi-decade opportunities and trends that we see out there. I guess we've kind of touched on a few other trends. I mean, Alex, in the context of property, referenced cloud computing. You touched on digitalization there. I mean, any other kind of broad trends that you think might be the really interesting place for equity investors to be exposed to as we look ahead, that kind of sits alongside this kind of decarbonisation trend?
Yeah, I mean, the two big ones are kind of decarbonisation and digitization. Cloud compute is part of that digitization. And I think almost in every industry you can now start to we just talked about automotive, the trend towards electrification. There has been a trend towards e-commerce relative to physical retail for the last 30 years. It's very easy to look at lots of different industries and see where those trends are. I think the really important one is to make sure that, first of all, you can identify who the winners are. And secondly, that they have some sort of identifiable competitive advantage such that they actually make some money out of it. So if you go back to solar panels or flat screen TVs, they were a small market that became a much larger market, but actually most of these businesses who invested in them made next to no money, or certainly didn't beat their cost of capital. Many of them went to the wall because there was no real definable competitive advantage. If you look at cloud computing, I think if you add together Amazon Web Services, Microsoft Azure, and Google, you end up with 80-something% market share of a business which is still growing in the order of 30% plus per annum, with sustainable margins. We think over the medium term of 30%. Well, certainly AWS is doing 30% type margins. That looks like an oligopoly structure, really big barriers to entry, which looks with good economics. And we're single digit penetrated compared to enterprise spend on computing globally. So a long runway of growth in front of us. That's the sort of business that naturally attracts us. So it's not just getting the trend and where you want to be invested, it's also finding the right vehicles to invest and to actually capitalize on those trends.
Okay, and I guess kind of, one of the, if we think about technology and adoption of technology, it's clearly been a huge trend over recent years. And I guess you've seen some significant winners in the US. You've mentioned the likes of kind of Amazon and kind of Microsoft there. But I guess the other region that's done particularly well from a technology point of view is Asia, and in particular China. Kind of you've seen a lot of growth opportunity there. I guess Alex has already touched on kind of, I guess, the intervention that we've seen from Beijing recently in this kind of common prosperity focus that they have. But any additional points from you, I guess, particularly around kind of how you're positioned in the portfolio and how you're thinking about China as you look ahead?
Yeah, I think we've done on lots of calls like this over the last 2-3 years. How many times have we been asked about kind of regulating big tech in the US? And it's happened again and again and again. And I think my standard answers has been I think it could happen. It will take a long time to proceed. Think how I think the Microsoft cases took over a decade. That's the rule of law. That's what happens in Western economies. What we've seen in the case of China is that overnight, let's suppose you'd have been invested in the China education names. Essentially, well, you got some rumors about what might happen, but essentially overnight, they removed that business. It no longer exists. So the share prices fell by in excess of 90%. And that's investing in a command economy. Now, I think, that makes you think about what sort of, China, as we all know, it's very big numbers, all of those things. It's lots of attractions. But when you're actually valuing businesses there is a risk premium issue to be taken into account because it is a different environment. I think, whereas, what we've done as a result, we've sold out of Tencent. I should make that clear. It was a small actor for us and we decided to remove it. These businesses look cheap now, but I think they're cheap because of the degree of uncertainty as to what the economics of those businesses look like going forward. In the specific case of Tencent, Tencent Music is having to unwind all of its exclusive content deals, all that type of thing. How that finally looks like, there's more commentary going back on video games, for example. Back in 2018 with Tencent, they went through a period where they couldn't actually launch and monetize any new games because of the regulations change that was occurring at that point. When you look at multiples at that point, the multiples went about 20% cheaper than they are today. And as yet, we haven't really seen any downgrades to earnings come through. I think that, there could be some more downside, difficult to say. I think it just becomes a very uncertain investment environment. The scarcest thing we have is our clients' capital, and we just view that there's a better use of that right now.
Okay, brilliant. Well, it's been really interesting, Neil. And I guess kind of to sum up, we've come from a very difficult kind of 18 months, kind of a volatile equity market period. But there's a lot of opportunity out there. But that opportunity really kind of sits within I guess the handful of truly great companies out there that can sustainably compound returns. It's less about kind of predicting the next company that's going to catch the wave of kind of reopening and kind of benefit from kind of fairly muted, I guess, medium to long-term GDP growth. So it really is about finding those long-term winners. And I guess that's what we're doing in portfolios. I see we've had quite a few questions coming in, but maybe before we open up for kind of some more broader questions, any final closing comments from you, Neil? Any takeaway points that you want the audience to
No, I think you summed up really well, Andrew. I think we've done reopening. I'm sure, yes, the last week there's been a bit more value. Next week there might be a bit more growth. But I think that is kind of we need to start looking forward again. Where do you want to place your chips for the next kind of 3 to 5 years? And I think that's I would say that was always our focus, but very much our focus right now.
Brilliant. Thanks, Neil.
Great, thank you, guys. So I'm just going to give Craig and Alex a moment to pop on their video. And we got quite a few questions coming through, and I actually just made a note on terms of the types of questions. I think it's very indicative of this kind of cycle that we're in, this kind of uncertainty between the believers in the growth cycle and obviously some rational fears around a sustainable recovery. It just brings me to that point you made, Neil, that reopening is not a straight line. And it certainly reflects, I think, in some of the questions and the varied questions that have come through. So I'm going to kick off with just some of the questions around this value growth cycle shift that we've seen sort of between, as you said, Neil, November last year when vaccines sort of started to be rolled out and to today. So I think we've got one question around whether or not we believe that that this sort of subsequent growth that's come through, how sustained do we think that is? So again, I think it plays very much to the question you've been facing around belief, as I say, in the cycle that's coming through. So I don't know if I'm going to pose that to Neil.
So how sustainable the growth is. There were no economic imbalances when we went into this downturn. It's a very unusual recession. So therefore, our government's going to try and stop it in terms of monetary policy or so on? No. So I think the expansion continues. Is it a very robust economic expansion? Are we going to do kind of 4 or 5% type GDP numbers next year? No, I don't think so. So I think we just go back to kind of where we were before that, 2.5% type GDP growth in Western economies, maybe a bit faster in some emerging markets, and it's good enough, I think. I don't know what Alex would think.
Yeah, I would agree. I would much rather see the sort of cycle you're talking about, what we call lower for longer, than that rapid sort of growth you get, leading to inflation, leading to central banks having to hit the brakes. I think just gentle, steady growth is very encouraging for the length of the cycle for economies, and therefore good news for equities. And as we said, if we don't believe inflation's there, why do we need to put the brakes on? Why can't we let the cycle gently carry on?
And I think that leads me to one of the next points that comes up quite often when we do these types of sessions within the global space. And it's kind of the ongoing QE versus tantrum debate. And I think with a lower for longer view of growth, it certainly might answer some of the questions coming through around, how bad could a taper tantrum get if we start to kind of see that unwind quite quickly. I don't know if there's any comments around that, but I think there certainly is a view coming through, at least in the questions, that there's still at least some concern around, the unwind of that, as well as ongoing long-term concern around QE in general. So I'm going to lump a couple of those questions together, which is, do you see in sort of sustained QE going forward if you perceive this growth cycle to not be as strong going forward?
Do you want me to have a crack at that one? When we last, the previous taper tantrum towards the end of the global financial crisis was partly because the talk of taper came slightly out of the blue. This time we've been talking about it happening for ages, and central banks have indicated the likely sort of program for that. And in the US, we're expecting the Fed to start talking about it openly towards the end of this year and actually start cutting back QE next year, early on next year probably. But if markets get what they expect, they shouldn't go through a tantrum. It should be business as usual in that environment. And they say that they will taper QE before they start raising interest rates. And I think interest rates really are far more significant than quantitative easing. So in an environment where we expect interest rates to remain low, gently going up later on, but only small amounts. I mean, the markets are factoring in very little in the way of interest rate rises over the next couple of years. Markets should be able to take that in their stride. And assuming that is the way we see things pan out, central banks will do it because they believe growth has got established again, and they've got the confidence to start just reining in on monetary policy a bit. So I don't see that environment as worrying. Clearly, what is worrying is if we're wrong about inflation, if inflation gets much higher than we expect, it seems stickier than we expect, going on for longer, and then central banks see the need to raise interest rates faster, cut back on QE quicker, that would be negative. But if they do the sorts of amounts they're talking about, which is very much what we expect, we think markets can handle that.
Thanks, Alex. And then, I don't know, Neil, if you'd like to make any comments?
Just very medium term. If you think about it, the average Western economy, the US, debt to GDP is roughly 100% now. We've added 15, 20 points of debt to GDP on during the course of the pandemic. If you think about it, that means that they're about 10% less debt to GDP compared to where Italy was pre the global financial crisis, and about 20% less than Greece was. And we know what happened there. So they need to walk a very, very fine line, and it's going to be very tough. I think what it means is there's some natural brakes on the economy should things start, if inflation takes off, if interest rates go up, there's some natural brakes on the economy. There will probably be some tax breaks on the economy because someone's going to have to pay for the pandemic. And the other thing is, I think it puts a cap on where interest rates can go. If the interest rate you're paying on your debt goes to above your nominal GDP growth rate, then you've got an unstable system. Debt to GDP continues to rise exponentially. So I think, over time, bond yields will remain probably a point below where nominal GDP is. That's nirvana for the central banks.
Great. And then I think in line with this question, we've actually got a question around commodities. And I think this also sort of reflects the question mark of how is there possibly some sustained drive still in this value cycle. And the question is around the $1 trillion US infrastructure spending bill. And do we believe that it could have a sustained effect on this commodity cycle that we've seen, even in the face of prices falling more recently?
I mean, if you look at $1 trillion, I mean, it's not insignificant. It's what, 5% of the US GDP, something of that sort of order. I think the new spend within that probably comes at around about 3% of GDP, and it's spread over a number of years. So positive, but I don't think it really transforms it. Will US copper demand suddenly become totally different because of this bill? I don't believe it. So it's helpful. I think there are other trends going forward. We've already talked about the electrification of the economy. That is very copper positive. And clearly, for certain individual commodities, I think there could be support. But do we get a generic commodity inflation? I don't think so.
And then in the interest of time, because I see we've got about 7 minutes left, I sort of compartmentalized the questions into kind of common questions I think that we get in this space around tech and some of the subsequent discussions that we've kind of had as ongoing chats with you around the tech environment. And I think we've answered quite a few of those in the sessions, and particularly some questions as well that have come out of the issues in China and Asia growth. But maybe one question I'd like to just pose is in the ESG space. I mean, we have a broad question on ESG investment, but I think maybe another way as well to pose it is to look at the specific ESG pressures that you're seeing in the growth parts of the market. And I think maybe particularly when we talk to things like technology, even Alex, who mentioned in his session around property and data warehousing and data storage and cloud storage and some of the ongoing kind of ESG questions that we have in that space. I wonder if you have any comments around that pressure in being growth managers and looking for sustainable growth in your realm, Neil?
I don't think it's, the first point is all investors are ESG investors. I don't think there's a choice at the moment. I think in terms of where cost of capital for individual securities is going to be driven by how they stand relative to those ESG metrics. If you look at something like technology, at the moment, I could fill my portfolio with technology stocks, software names, and I would have a much lower carbon footprint than the market out there. That does nothing. It achieves nothing. It does not move us towards net zero. By the time, I guess what was hinted at by this question is the fact that actually, if you actually take all the scope 3 emissions into account for something like running a data center, then technology no longer looks as clean. But I think, so when we're looking at, all of our investments, we don't just want to look at the level of, say, CO2 emissions that they have today, but we want to also see how they're going to move forward going, over the next 5 to 10 years. And that occurs whether it's an oil company like BP or whether it's a data center operator like Equinix, which we have in the portfolio. So yeah, I think you need to look at every single investment with that sort of mindset involved. And technology has some big challenges as well. We've had a recent issue from a social side on some of the gaming stocks we invest in, on one particular one called Activision, which has hit the press over the recent weeks. Those sorts of reputational damage type issues are really significant. If brand matters to you, it can destroy you overnight. So having an awareness of that and how those sorts of issues are managed is very much important to us as investors. So yeah, ESG is in everything. I don't think you can avoid it.
Thanks, Neil. And then inevitably, we always get the SA versus global questions for you. And again, I think the range of questions is quite wide this time. So I'm gonna sum it up because we've got 3 minutes, and just maybe a quick view, and maybe Alex, you'd like to start in terms of a regional view on South Africa versus the global market at the moment.
Yeah, we, to be perfectly honest, see better opportunities in quite a few other markets. There's no doubt, we've talked an awful lot about technology. We've talked about competitive advantage and so on. And in many of them, there's such strong trends taking place in the world at the moment. The whole shift to online, the whole shift to streaming, the whole shift to the cloud, the whole shift to cashless payments. Really strong movements, and all of them have been exacerbated by COVID. And you want to play these trends, and you need to be in the strong companies. As Neil said, you've got to have competitive advantage as well. And so, to be perfectly honest, the sorts of winners in these growing areas tend to be in some of the much larger markets. And the US is one area where you have got a lot of those global leaders. There isn't an Amazon elsewhere. There isn't a Google elsewhere. There isn't a Microsoft elsewhere. The cloud is completely controlled by the US. So as far as regional allocation is concerned, that is an area we find very attractive. And there are cases elsewhere in the world, but to be perfectly honest, and not wanting to be anywhere derogatory about the opportunities in South Africa, and there are opportunities, definitely. There aren't the same number of global winners in that part of the world.
No, certainly, thanks, Alex. I think it draws attention to one of the questions that specifically asked about sort of sector allocation that you can gain exposure to, that you just cannot in the South African environment, and it's one that we often discuss. So thank you for that. As we draw to a close, I just want to bring to your attention the one probably most important question on the box from Arnold Basarabi. Thank you very much. Any comment on SA beating the British Irish Lions in the recent rugby series?
I'll leave that one to you, Neil. All yours. Or Andrew, perhaps as the consummate traveller, you're probably more up with it than the rest of us.
My only comment on that would be, it would be a different story if Finn Russell had been playing for the entire series. Possibly. As a Scotland supporter, I can say that.
Well, thank you very much, guys. I must say I'll definitely enjoy having you all back in South Africa as much as we enjoyed having the Lions here. So thank you very much. And thanks to all the questions. I am sorry that we weren't able to get through any of them. If there's anything really burning, please do consult your local BDM and chat to them about making sure that we get an answer for you. As always, Columbia Threadneedle manages the STANLIB Global Equity and Global Balance funds. And as you can see, we have a very close relationship with the business, and they're always happy to engage with us here in South Africa. Thank you, team in London. I'm sure it's just 12 o'clock for you, so have a good afternoon today, and cheers to everybody online.